Academy. Today we are back with lesson number 7. So in lesson 6 we covered the risk to reward and why win rate does not really matter as much as structure. Today we're covering stop loss placement, where to place it and why it actually matters. So a stop loss is not random. It must be placed where your trade idea becomes invalid or incorrect, in other words. So today we'll be looking at the Solana chart on the 4-hour view. Let's get it started with step 1. So what is a stop loss? A stop loss is a price level where you accept that your trade idea is wrong or invalid. It protects your capital from unlimited downside. It is not a prediction tool, it is rather a risk management tool. So right now on our chart, I have our support as well as our resistance covered up. So just to repeat from last lesson what a stop loss is, if I place my trade over here, let's say in the perfect world I caught this buy and I put my stop loss at that low and I'm targeting this area over here. If price does happen to come down and touch this level over here, my stop loss will be hit and my trade will automatically close, meaning my trade was now invalid. So that is just what a stop loss is. Moving on into step 2, stops must be based on structure, right? Stop losses should always sit beyond structure, not just random distances. If you're buying at support, your stop loss should sit below support, and if you are selling at resistance, your stop loss should sit above resistance. So let me just, okay, actually I have it thrown out already. So ideally, just like in the previous example, if I took this trade, ideally I'm placing my stop loss below this low as well as these lows, just to give my stop loss some breathing room, and targeting this area over here. Always targeting from support to resistance and vice versa, resistance to support. So always keep this room here because price could come down and push back up, but you also don't want to keep it too tight, but we'll speak about that in step 3. So moving on into step 3, what not to do with your stop loss. Do not place stop losses too tight to increase your position size, and do not move stops emotionally after entering. So an idea of a tight stop loss would be this over here, just like trying to get the perfect risk to reward ratio. Like look at this is 1 to 10, right? This is a very tight stop loss. Actually in this example it would have worked, but this in most cases price will come down, likely get into your negatives and then push around this area over here and then maybe push up or hit stop loss. So having a tight stop loss here is just not going to work. In this example right next to it, actually most traders would have entered off of this first candle over here, maybe placing their trade on top of that and then putting their stop loss, it's very low, and putting their stop loss below these lows over here, right? And as you can see, price came down and actually hit their stop losses, and once it hit their stop losses, actually went up to their take profit, right? That's because these traders are having too tight of a stop loss, not giving their stop loss any breathing room, and just wanting to get the perfect risk to reward ratio. And then the second mistake people do, I can actually use that same example, is perhaps, let's say this second group of people actually place their stop loss properly, and sometimes, just move this here, and sometimes they see this movement over here and they think, wow, I don't want to lose any money in this trade, I'm already in profit, let me just move my stop loss to break even. And most beginner traders actually do this a lot because it seems like a no-brainer. Just like my two options are I either make no money and I end at break even, or I make money, right? But in most cases, if you are placing your stop loss at break even so close to your entry, in most cases you're just going to come back down to your break even and then you'll be hurt more in the future and in the long term when price reaches your TP or goes back into profit. Just like this, it happened here exactly. So traders put their stop loss at break even over here. Price went up a bit, came down into their break even, actually came a bit lower, and then went into their take profit. So that's the two things you do not want to do when placing a stop loss. You don't want to place it too tight, and you don't want to move it emotionally. Tight stops without structural reasoning always lead to frustration. So moving on into step 4, always balance stop placement with risk to reward. Your stop loss affects your position size and your risk to reward. If the top is too wide, your position size must be smaller. If the stop is too tight, you may get stopped unnecessarily. What does that look like? So if you place your trade over here, if your stop loss is, let's say, below this low over here and you're targeting 1 to 2, you have to use a smaller position size, or you have to lower your leverage. Well, if it's too tight, just like the example we already saw, you might get stopped out unnecessarily. So always just trying to give yourself that breathing room so that you can allow price to do what it needs to do before eventually hitting your target or maybe hitting your stop loss. So your stop placement must always make structural sense first, meaning always above resistance and always below support. A stop loss, okay, actually moving on into step 5, a stop loss is not failure. This is where the professional mindset comes in. A stop loss is not failure, it is discipline. Taking a small controlled loss keeps you in the game long term. So always before entering a trade, ask yourself, where is my invalidation, aka where is my stop loss, and is this level structurally correct, or am I trying to use the perfect risk to reward? Am I trying to have a good, very tight stop loss? It shouldn't be either one of those. It should always just be structurally correct. So your stops always protect your capital, and your capital creates your opportunity. So that is all for lesson number 7 today, guys. Next lesson we'll cover liquidity and why markets often move beyond obvious beginner levels. And always remember, protect capital first, growth comes after. Cheers, guys. I'll see you.